Hi guys, this is Router FX. Don't forget to subscribe to my YouTube channel. In this video, I'm going to teach you how to identify market structure and how to use market structure to make your trading decision. We have three types of market structures. We have a trending market, a choppy market, and a ranging market. When we say a trending market can be an uptrending market, or it can be a downtrending market. So I will use this sketch to explain into details how trending market works. So first of all, the market makes a certain high. As we can see here, the market makes certain high, and then the market push to the lower side to make a new low, a certain low. Now after that, the market retraces to the upside again, and then it makes a new high. So we have a low and then a high. Now the market move impulsively to the downside to make a new low. This new low is lower than the previous low. Then the market retraces again to the upside and then to make a new high. And this high is lower than the previous high. Then the market move impulsively again to the downside to make a new low. This low is lower than the previous low, and then retraces again to make a new high. This high is lower than the previous high. We say a higher lows. Then the market move impulsively again to the lower side, make a new low. This low is lower than the previous low, and then retraces again to make a new high. This high is lower than the previous high. So we say the market makes a lower low formation, or the market makes a higher low formation. So the recent high is lower than the previous high, or the recent low is lower than the previous low. So we say in a downtrending market, we have to see a lower low formation, then we can classify that market as a downtrending market. And once you've been able to identify a market as a downtrending market, then all your decision should be in relation to the trend. So you always have to look for a sell entry alone. Now, the next type of market structure I want to talk about is an uptrending market. In an uptrending market, the market makes a higher high formation and then a lower high formation. So first of all, this is a low, and the market move impulsively to the high to make this particular high. This high is higher than the previous high. This particular high. So let me put so this particular high is lower than this high, or this high is higher than this high. So we can say that the market is making a higher high formation. Then the market retraces again to the downside to make a new low, and this new low is higher than the previous low. Then the market moves impulsively again to make a new high. This high is higher than the previous high, then retraces again to make a new low. This low is higher than the previous low. Then impulsive again, make a new high. This high is higher than the previous high. Retraces again to make a new low. This low is higher than the previous low. So we say the market is an uptrend. So when you identify a market as an uptrending market, then you look for a buying position only until the market change direction to either the downside or a different market structure. Now the next type of market structure I want you to understand and also know is a ranging market. So a ranging market is when a market moves in between a well-defined resistance and a well-defined supply zone. So this is a resistance area that the market has been moving in between, and then this is a support area. So when you identify a market moving in between a well-defined resistance and support, then we say this market is a ranging market. So the market is moving between a specific resistance level and a specific support level. So we say the market is a ranging market. So trading with a ranging market is also very easy. What you do is that you will have to wait when the market hits maybe the resistance level, then you look for a sell signal, then you sell the market. Then your target should be the support area. When the market reaches the support area and you see a signal for a buy, then you buy the market. Your target should be the high level, the resistance level. Then when the market hits the resistance level, when you see a signal for a sell, you sell the market again, and your target should be the support area. So that is how we trade with a ranging market. Then the next type of market structure is what we call a choppy market. In a choppy market, we don't trade it. In a choppy market, the market do not move. The market moves in an undefined direction. So the market is just moving anyhow. So there is no clear trend of the market. There is no clear direction of the market. So when you notice that the market is moving haphazardly like this, then you know that this market is choppy. So you don't trade choppy market. You have to avoid it until you see the market trending. And once the market starts trending, then you can start making your trading decision. So guys, that is the three main types of market structure we have on the forex market, and then that is how we trade them. So if you want to learn how to trade with the uptrending market, you first of all, when the market push to make a new high, then you wait for the market to retrace. When the market retraces to make a new low, then after that you look for a signal, then you buy the market, target the previous resistance level. Then after a retracement, then you buy the market again. So then in a downtrending market as well, you buy the market you sell the market after the retracement end. So for example, when this market retraces to this side, then you look for a sell entry to the downside. When it retraces again, you look for a sell entry to the downside. Retracing, sell entry to the downside. So that is how we trade with a downtrending market. So this is an example. This is a live chart of Bitcoin, and then you can see clearly that the market is moving in an uptrend. So the market, this particular low is lower than this one, or this one is higher than this one. Then it makes another low again, which is higher than the previous low. Make another low again, which is higher than the previous low. Make another low again, which is higher than the previous low. So we say that the market is making a higher high formation, or make a high which is higher than the previous high. This high is higher than the previous high. This high is higher than the previous high. This high is higher than the previous high. Then we have an example of a downtrending market as well, which is also making a lower low formation as well. So you can see clearly, even without using a trend line, that the market is in a downtrend or the market is an uptrend. So guys, make sure you learn this, and it's going to help you to understand how forex works. Don't forget to subscribe to my YouTube channel, and I will see you next time. Bye bye.